Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. All right, risk markets rallying pretty sharply yesterday. We had about a 2% move across most indices. Big banks injecting $30 billion of deposits into First Republic Bank to restore confidence in the banking system. So that was really taken well by the market, as you'd expect. Europe did have a dip briefly when the ECB hiked 50 basis points. Which is what they said they were going to hike, but the market didn't believe them. Then they hiked. It took a little bit of a drawdown, and then it rallied in line with everything else when the news about First Republic came out. Industrial commodities like oil and copper did stabilize as well. And then gold managed to push a little bit higher as well, now sitting at around 1930, which is not far away from the highs that it made in January. Vol-wise, we did see vols hit hard. Obviously, a reduction of systemic risk gets taken well by vol markets. So you can see here down substantially, around 3 vols plus in most of the indices. But there's still plenty of room for these vols to come down, especially in Europe, which is still up about 7 vols on the week. But we've got OPEX today, we've got VIX expiry next week, and we've got FOMC. So as all those things kind of play out, there is more room for vol to continue to come back down if we don't get any material weakness coming back in terms of what's going on with the banks and stuff like that. Commodity wise, we saw about a 1 to 2 vol drawdown as well, as just risk coming out of the system. Carry wise, we do see as implied vols have come down on the rally. As I've flagged before, you see carry flip from positive to negative. So you're seeing nothing really in Nasdaq and S&P, deep negative here across Europe. But I wouldn't get too excited about buying loads of gamma on this negative carry, because remember, it's backward looking, right? These realized vol numbers, these 10-day realized, are all backward looking what just happened. It's not necessary that that's going to happen tomorrow, right? So if we do find some stability now that we've bounced and market just kind of bide time to see what comes out of the FOMC, you might see realized vol come down, you might see implied vol stabilize, and these numbers then flip back towards green again. And so it's not so obvious that you're going to make a load of money buying gamma at this juncture. And then if we look at commods, oil and uranium are still in positive carry with everything else negative. Skew did also come back. So a decent move back down in skew, it's in the 80 percentiles, heading lower again. Still plenty of room to come down though, in terms of where it is, especially in Europe. And we may see further downside put selling pressure coming over the next few weeks, like we said, if we get the right sort of noises coming out of FOMC. In terms of commodities, it was a mixed bag. We saw a bid coming back to precious metals skew. We saw nat gas skew and copper skew offered. Okay, moving on. So obviously we talked about the bailout. So you had the likes of Bank of America, Citi, JP, GS, MS, Wells Fargo, all committing to put $5 billion or $2.5 billion each into this, deposit this into First Republic. Now, a lot of these banks had benefited from the kind of bank run that people had taken deposits out of them and put them into the big banks. So all they're doing is using that extra deposit base that they've acquired to then shore up First Republic again, right? So it's just a bit of a musical chairs, really. And then the SNB, obviously backstopping Credit Suisse the day before, has helped markets kind of calm down a bit and not be quite so scared. We do think options market dynamics have also provided a tailwind. This is something that we had flagged in our call with Brent from Spot Gamma on Tuesday. For those of you who dialed in, we kind of thought that Vanna and Charm effect was going to be supportive, but we needed that good news to really bring volatility down, and we got that. If you look at the S&P, it's been evident in the S&P performance, right? So high yield credit spreads, that's how they moved. S&P didn't, if this is going back to kind of December, so they were tracking each other pretty well. High yield credit spreads did blow out relative to what the S&P sell-off looked like. Now, the S&P did benefit from the fact that it's quite heavily weighted in these mega cap tech names, and they have been seen as somewhat of a safe haven. Also, the fact that interest rates have repriced down so dramatically tends to do good things for those tech stocks, basically, right? So we think that's one of the major reasons why the S&P has outperformed. But we've got this big OPEX as well. $2.9 trillion notional of options expiring today. So it'd be fair to assume that there's been some delta hedging of the charm effect, where all those puts that are expiring today have kind of been eroding in value, and delta is being covered by dealers. And then also the Vanna effect as well of implied vols moving down has the same impact, where the dealers need to cover deltas. So we think that's definitely helped. Now the big, we've said the post today's expiry, VIX expiry is coming up next, and we've got massive call option open interest in the VIX. If we look back over the past few years, 2018 was similar numbers, and then 2017 there were these big numbers here, but a lot of that was probably related to the lead up to Volmageddon, where vols were at crazy low levels. But the point being that there's so much open interest for next Wednesday's VIX, that it is likely to continue to have an impact in terms of not the Vanna, but the charm flows, let's say, as those call options in the VIX get closer to expiry and they lose their value, they also lose their delta. And dealers who are long VIX futures against them will then need to sell those VIX futures out. So there may be continued pressure on the VIX and continued support to the S&P into that VIX expiry because of those sort of dynamics. So something to be aware of. And then after the VIX, you've got FOMC obviously that evening. The VIX expires on Wednesday morning. FOMC is going to be that afternoon. But then the options space is going to be looking at the 31st of March expiry, which is quarter end. And that's where we've got this 40-60 strike, 40-65, sorry, which is a JP Morgan collar call strike, which is there in like $20 billion notional, which, we may well find ourselves somewhere near that strike if Powell doesn't give us a shocker and confirms the dovish pivot in rates markets. Then we may be able to pop up towards, it's not a million miles away from where we are today, right? We're talking about 100 points higher. If we get there, the dealer community is going to be flooded with a load of long gamma now suddenly, and that may well exacerbate the kind of sell-off that we see in vol that could happen, right? So these are all dynamics to be aware of when you're watching the market over the next couple of weeks. Okay, so we see a potential window of strength into and post FOMC if Powell doesn't completely reverse the recent pricing in markets with his comments and his projections for growth and inflation and things like that. If he just acknowledges that recent events in the banking sector will have a negative impact on growth and inflation, that will likely be enough for the bulls to latch onto and try and take this market higher, in my opinion. Okay. Now, looking at our strategy compass to try and identify where there might be some opportunities, this is our go-to, where we try to see what's going on. In equities, obviously, we had a little bit of a bounce already, but UKX, FTSE still fairly oversold near the bottom of the range. So selling puts is flagging as a potential trade there. In terms of commodities, we've got copper and uranium calls looking potentially interesting. FX generally looking like a sell in terms of vol. Most of these things trading above, probably the most expensive out is the Rand right now, South African currency. Not something I trade a lot myself though. And then here we've got XLF still screening as sell puts. That's not for the faint-hearted. Clearly, we would prefer something safer like call ladders, which we've done. And then even here, XME and XLE. These are pretty oversold down here, these commodity sectors. So we quite like the idea of call spreads, call ratio, call ladder type structures that don't buy you too much vol, but get you long these things. We did execute some XLE bullish risk reversals actually for our book the other day in a sensible size where we're happy to take delivery to add some allocation into XLE at 10% discount from current. That's the way you think about it when you do those trades. But if you don't want to take on the downside risk, maybe some call ladders or call spreads can make some sense. So anyway, homing in on the FTSE that we said is still quite beaten up. So the FTSE's been hurt by the likes of energy and financials and materials that have got hit hard. So you had a nice sharp move down there, down into the kind of retracement zone, the 50% retracement zone from that entire rally since October. So we do think that, if the moves by authorities and the large US banks, if they do bring some stability back to markets, which it smells like they could do, getting some long exposure to this type of index that is fairly defensive but has been beaten up could work well, right? So we look for potentially underwriting opportunities, right? We don't think this thing necessarily rallies back so aggressive and so fast because it looks like tech's leading us in terms of the rally, right? Because rates have come down. But we do think that this thing might have limited downside given how aggressively it's come down. It got into very oversold territory on the RSI. So we do think there's some potential, and the way we would maybe play that is by underwriting, which basically means selling puts. Okay, so our dashboard tells us sell puts is the trade here. Obviously, that's a mean reversion thing. Realize has been high, so the carry indicator doesn't back that up because it says we're moving. But like I say, remember that is backward looking. Where these big sell-off moves here, if you think those are kind of done now, then we may go back to a lower realized, which we had previous. And that's really what you're playing for. Skew has obviously had a pop across all the indices, FTSE included. So skew here, and then inversion in the term structure here is showing us, April. Obviously, March is on the moon. When I say March, the 1 week stuff. I'm thinking April is probably where you'd want to go if you were selling. And you look at the vols here; they're kind of near the top end of the range, obviously here. Now, the type of thing I'm looking at. All right, that's it for today, and that's it for this week. And I'll catch you all next week. Have a good weekend. See ya.